So without further ado, I want to introduce today's speaker. Before I start talking about Pete's background and everything, I just want to say that we're very honored that Pete was able to come and be with us to be the first speaker of our second iteration, Speaker Series 2.0. You know, he's in demand all over the place as a speaker in this town for sure, and to get any of his time is a real treat and a real honor for us. Pete's title, he's the Senior Upstream Research Director and Advisor for IHS Markit, which is the new iteration of IHS. Before that, he was an exploration geologist at Mobil Oil. And I'm just going to run down through a couple of his things that he's done in the past. And sorry, I got to put my glasses on here. Pete's authored all kinds of papers, you know, in the industry. He's been around for years, and you know, it's a treat for me to be able to spend any time at all with someone with Pete's level of experience. He's written papers on E&P databases, hydrocarbon shows, horizontal drilling, U.S. natural gas, global oil and gas resources. He's co-authored IHS studies on North American gas supplies, unconventional gas supplies, North American global tight oil. He's been on boards and committees at AAPG, PPDM. Educationally, he's got his bachelor's degree from University of Oklahoma, master's and PhDs in geology from University of Wisconsin. He's chairman of the board of visitors at the University of Wisconsin, where he was honored with the Distinguished Alumni Award. He's received honorary member award from AAPG, IHS Chairman's Award, Koga Lifetime Achievement Award, Who's Who in Energy, both Denver and Houston. I mean, long story short, Pete is a highly respected contributor to the energy industry worldwide. So having said all that, Pete, I'll turn it over to you and let you take it from here. So let's welcome Pete Stark.
Thank you so much, Jim. It's really a pleasure to be here with you today. And I've been very interested, and we at IHS have been very interested in the GEM program. And we have a significant effort in the company to be a good corporate citizen, and I know this is one of the areas that we're really pleased to help support and contribute to. In a way, I wish I had picked a little better title for the presentation today, because what this is really all about is the global energy business is undergoing a sea change. It's a huge transformation, and fundamentally, I'm using exploration as the focus for how the transformation is occurring, but hopefully you'll realize that we have information on all of the other energy sources and the production, and you'll hopefully get a feel for this exploration side as just a part of the tremendous transformation that's underway. I want to frame what's going on right now, the setting in the industry today. Lots of things going on, some of which we can't predict, but there are things like the OPEC meeting at the end of this month, which may trigger a different outlook for oil and gas, particularly oil prices and supplies going forward. So lots underway. Then I want to look at the history of exploration, because exploration was the driver for finding new oil and gas resources and transforming then those resources being transformed into supplies, critical to the whole history of the, I guess, the oil era to world energy. Then I want to look at the exploration facet of that, and then some of the new things going on that are changing our thinking about how particularly the oil and gas industry within the context of energy environment overall will change going forward. So we don't have the answers, but we clearly understand the change issues, and be very happy to entertain your questions. And please, if there's a question, something's not clear, as we're going through, just raise your hand and we'll try to address it when it's timely and on your mind. So let's look at the oil market setting. And number one, as much as hydraulic fracturing and unconventional drilling get harpooned by segments of the public, it was the surge in North American tight oil and shale gas that have driven this sea change that's underway and totally changed the supply side outlook going forward, and oil and gas flows and prices. I did a back of the envelope calculation the other day to get an idea of what this means globally. If we hadn't had the breakthrough in hydraulic fracturing and horizontal drilling, we'd be living with plus $100 oil today worldwide. We'd also be living in the United States with $12 to $15 gas rather than $2.73 gas. I just looked at, and I took a modest view of what the prices are today versus what they would have been like without this breakthrough. And it adds up to $6.8 billion a day of reduced energy cost. That's 90 cents per person per day worldwide as the result of this. And I think keep that in mind for what a fantastic value contribution is behind what is looked at otherwise. If it's in your backyard, it's a huge controversy and ought to have a silver stake through its heart. Well, the size of that, the silver stake is looking at a fairly big global value. So world oil markets are in the process of rebalancing. They've rebalanced slower than we thought was going to happen. There's moderate demand growth and economic growth. And this OPEC meeting on November 30th is going to be very key. And we felt all along from when the early announcement from Algeria that Saudi Arabia was and others in OPEC were looking at coming to some agreement on how they would curtail or at least form a ceiling, a lid to their production growth, what it would mean. But the real trick is it's between Saudi Arabia and Iran. And neither one has a real great motivation to blink and agree to cut production. I'd say particularly Iran is the one that's more reluctant to do any cutting. So in this transformation in the United States, and because prices dropped so much, what we've seen in the last 2 years is a huge, huge increase in capital efficiency, lowering of costs, and it has made just a huge difference in break-even costs. And I'll show you some charts on that so you'll get a flavor. We've focused on that in North America on the unconventionals, but it also is happening globally and particularly in deep water now. We're seeing 30% cost reductions last year and maybe not as large this year, but in the same pattern, and that's critical going forward. We also see that led by the Permian Basin, US oil production is poised to resume growing. And that always has been kind of one of those questions because costs, the prices fell way below what break-even costs 2 years ago. Hey, $60, we got to have that. There's a larger and larger amount of oil in particular that has break-even costs of $45 or less now, and the Permian Basin is key. We think that the U.S. production from the low point, which is about now around 8.4 million barrels, will grow almost 2 million barrels a day into the early 20s. So, but there are lots of things that can cause a hiccup in that path. And then the last thing I want to set is that the oil and gas industry worldwide there is really challenged by the environmental climate change and coupled with anti-hydrocarbon sentiments. And what we're seeing is that as policies around the world, the Paris Accord and things like that, depending on how vigorous policy, policy statements are targeted to the 2% 2 degree change in world temperatures, huge impact on oil demand. And OECD oil demand actually peaked several years ago. It is feasible that world oil demand, not supply, can peak during the 20s. And it, don't know exactly when, but that's on the path. So let me, with that setting, this is just the outlook from IHS looking out to 2040 of the various change in resources with one scenario. This is more or less a business as usual scenario without an unusual strict switch to renewables, kind of on the path percentages that we've been going on. What you see there on the bottom, you see the renewables, and it doesn't look huge, but it doesn't seem to be, I probably picked there we go. But renewables more than double their share from a lower spot, but it's one that grows. Natural gas grows a lot. We see coal slowing dramatically, but coal is still the most readily available and cheapest form of large-scale energy in many parts of the world, and it's not easy just to replace it as rapidly as we've done here in the United States. And you may be aware that because of the replacement of coal power by natural gas in the United States, and China also has slowed down its path of coal-fired power implementation, that CO2 growth has plateaued for the last 3 years. Really great outcome. There are things that if the economy starts growing more rapidly that could change. But what we see as natural gas then looked at to be major growth, and oil eventually beginning to plateau. Well, as I pointed out, when that plateau occurs will be greatly impacted by policy uncertainties. And how critical does the world perceive the climate change issue to become? So that's a model, and we have other scenarios we also look at that have quite different pictures. So let's look at what's going on now in the rebalancing. And what you see is you see the growth of the US unconventionals here in the blue. Then OPEC, the Saudis made the decision back here that they would no longer try to defend price. They would switch and try to defend their market share. So in gray, that's the surge of OPEC production, and it then drove the reduction in US and other non-OPEC supplies took the hit, while OPEC production gained a bigger market share. But then we do see going forward, as the market is rebalancing, US production will begin to grow. And one of the things on the right, you see the huge amount of excess supply of crude oil in the world today. And I just noticed for a while, US oil storage was dropping quite, it was over 500 million barrels. It dropped to into the 470, but it's back up close to 500 again recently. And so it still is a problem to be dealt with. What you see is that OPEC was talking about reducing its production to 32.5 to 33 million barrels a day, but in the period of time since the Algeria meeting, they've grown their production to 33.8. So everybody was pushing opening the valves so they would have a higher number against which to, if there was a reduction, they would be as high as possible. So that's part of the dilemma going forward in what will happen on the 30th. Just another way of looking at it, there were 3 phases in this. The blue phase, this is that was OPEC oil, the growth of US, Canada, and Russia, and then the rest of rest of the world. And phase 1 is where the Saudis, it caused a flattening of US and non-OPEC, and then you had the drop in US and non-OPEC while OPEC surged. And then going forward, phase 3 into 2018, we see the US, Russia, and Canada increasing. OPEC also, we think, can go forward depending on what happens on the 30th. So if you look at what happened in prior bear markets for oil, and we go back to the period, in this case of 1981 to 98 on the left, what you see is at that time, demand for oil dropped significantly. And at the same time, the excess capacity for supplies grew. It was 11 million barrels a day of excess capacity, almost 20% of the world demand. Where we are now is totally different. We still have demand growing at 1.2 million barrels a day, and spare capacity now is under 2 million a day. What that means is if there's a hiccup in a major producing country like Iraq or Iran, we could get some real spikes in prices just because there's no cushion anywhere in the world to readily replace that as there was back in the 80s. So that's an interesting aspect of where we are today. Another aspect that's driving some of the decision making and the thought on supplies and might have an impact on the OPEC meeting on the 30th is if you look at Brent, I'm sorry, click the wrong button. If you look at Brent oil price here coming back up into about the $50 range, and then oil supplies going forward, what you see is the impact on a large number of the major producing countries has been huge economically. Here's Iraq and Venezuela. Venezuela's in huge trouble. I think, I'm sorry, we're looking at Algeria here, Angola, Nigeria is over here. Nigeria is also, depending on how you set your scales, the point is all of their economies, their income relative to GDP, they're all in the red now. So one other view to look at, anyway, that's a problem. I mean, there's a big part of the world that was depending on energy production to drive their economies, and they are in trouble. So the other part is understanding the transformation of transportation sector going forward relative to oil demand. And that is not really fully known how it'll turn out, but what we see is that if you look here, oil demand is clearly the greatest component, gasoline demand for transportation is the biggest component of oil demand. We see it flattening under our basic scenario, but it is feasible that depending on how various climate change policies move forward, we could see that plateauing occur beginning as early as in the 2020s. Now let's look at our modeling of the impact of the climate change policies. If you see here on the, essentially it's global oil demand, and this is without the gas liquids in it, but we see rising from 60 million barrels a day up to essentially 100 barrels a day by in 2020. And I'm sorry, that's 2040, excuse me. So this is what we project going forward in our sort of business as usual. Here's the Paris Accord, what that would mean, about a 10% difference. If we look at other more stringent policies to curtail hydrocarbons, reduce greenhouse gases, it could be about a 20% reduction. And if you look at a 2-degree case, it's more than a 30% reduction in oil demand by 2040. So those are things, we don't know the answer yet, but somewhere in that range is what the industry, you know, this peak in demand could occur, you know, between these two and be different going forward. But that in general is the shape we see that the whole world energy business and the issue of dealing with climate change, that we're dealing with that picture. So, sorry, that was a bold click. So we're looking at sort of a survival of the fittest mentality. If we look at our standard case going forward with the increase in demand going up, and this is without the NGLs, about 45 million barrels a day of new production is required to offset demand in existing production and to provide new supplies as forecast. And we see this is stuff we have to find, then tight oil, then the green part are on projects that have been sanctioned, but many of these sanctioned may not be, are probably not economic at current prices. So there's a lot of uncertainty in that. But going forward, 1 million barrels a day going forward is needed just to replace the, you know, hold things even. So it means that the business is going to be healthy going forward, but just not robust like it sometimes has been. Here's what's happened to investment. And this is, we took the 60 biggest companies in the world that have about, I think it's like 80% of the world spending in upstream. And you can see, oh, sorry, excuse me. There we are. You can see the oil price here at the top as it collapsed. Then you see spending going from over 92 billion, dropping down now to an estimated in 2016 of almost a third of what it was. And this is our oil price projection going forward. We don't see oil price getting up to $70 without a hiccup somewhere in the world until 2020 now. So that's a much lower rate of growth in oil prices than had been predicted before. But the point is, what we'll look at soon is that all of this efficiency that the companies have gained allows us to produce a lot more oil worldwide at lower prices than anyone thought possible 2 years ago. That's a part of the change going forward. If we look at the history of global discoveries since 1950, with the gas in red and the oil in green, what you see is, of course, and this is the number of wildcat wells drilled. Well, you see the surge in discoveries here in the 60s into the early 80s. And then because we've had, you know, during the 80s, we had that bear market that impacted the amount of drilling and also the amount of drilling and investment, because we moved from being an onshore oriented business with lower cost wells into, you know, from, you know, several $1 million wells or $10 million wells into $100 and $200 million wells. So that's, but the concern is here. You see in 2015 and 16, we're seeing the smallest amount of conventional oil discovered around the world since 1952. So that is a part of the conundrum. And what does that mean? Well, there are different facets of it. This map shows the discoveries just in the decade from 2000 to 2010. And this is part of a paper that will be published, by the AAPG in 2017 on the giant fields of the decade. But what you see is the bubble sizes are the size of the discovery, and oil and gas. You see a lot of giant gas discoveries, but we added the North American unconventionals. And if you look at the numbers down here in the amounts of oil and gas conventional internationally, and then the North American unconventional adds up to about 44% of the giants in that decade were North America. North America in 2000 was DEAD for future exploration. So this breakthrough in unconventionals has been huge, and it is ongoing. We don't know, it's not easy for take-up of unconventionals in other parts of the world, though. The reason is it takes you have huge numbers, you drill a lot of wells, you have a big supply issue, lots of sand, lots of water. So you have to have a mature, efficient logistics system for unconventional plays to work elsewhere in the world. And there are not many places like that. Also, the legal systems, the business condition, it's just out of whack. It happened in the North America because we had the wherewithal, we had innovation, we had competitiveness for it to happen. If you look at, are we running out of giants or just ideas? Well, we came into a whole raft of new giants in the unconventional part of that breakthrough. But what we see is on the oil side, we see since 2005, a decline in the number of giant oil fields. Gas is a bit different. We've had East Africa off of Mozambique, huge numbers of giant gas fields there. We had also the Falklands have had some too. The only problem with some of these is that how do you commercialize it? You know, you have 50 trillion cubic feet off of Mozambique, and it has to be billions of dollars of investment to transform it into LNG and transport it. And we'll take a look at the competitiveness in that area, but really a change in world conventional. If we look at what's happened in those discoveries by setting, the yellow being onshore, the blue deep water, you see a lot more happening percentage-wise in the deep water, even though number of discoveries have dropped. Deep water has been, for conventional discoveries, really since 2005 has been the real King Kong area. But recently, the number of large discoveries has dropped, costs have been high, so that transformation that's happened onshore needs to happen there as well. Another aspect of supplies to be aware of is that on this chart, what you see is the number of discoveries here in the blue annually, and then how much new oil is actually added by its new zones, new technologies, enhanced recovery in existing fields. So back on that one slide I had from 1950 to date, technology is rejuvenating a lot of production from those older fields. And it is significant. And I'll show you the model for that in the US Permian Basin. Who was doing the discoveries is also interesting. In this last, since 2005, the last decade, the national oil companies led by Petrobras in Brazil, really, they were discovering more oil and gas than anybody else. The majors, oil companies, Exxon, Texaco, Chevron, I'm sorry, Texaco is a part of Chevron now, Shell, ENI, et cetera, but not so big. And there's a pretty good sized pie there in the greens. And you see going forward here in most recent years, that greenish color are the independents. Smaller companies have had a pretty increasing role in the percentage of discoveries going forward. I'm not going to get into that anymore here because there's a big issue of which companies, and if you're working for an oil and gas company, which group of companies, which parts of the world will be successful in the environment going forward. So it is a critical issue. I just won't beat it on the head anymore. So the model that we think is really critical, we are calling a super basin, and it's the Wolfcamp Shale and the Permian Basin that have given us the information or understanding of how companies are combining the new technologies with an enriched understanding of, instead of I'm looking at unconventional, I'm looking at oil, I'm looking for gas, I'm looking for carbonates. If you put it all together and look at it from a holistic point of view, you get a much different pattern. So what's happened is, for exploration in the world and production, the conventional oil and gas is over here, high porosity, high permeability, sandstones and carbonates. This is the offshore domain. Then there's been movement into enhanced recovery. Then with the breakthrough in unconventionals, we jumped way over to the right side to super low porosities, super low permeabilities, the tight rocks, and have revolutionized this. So what's happening is companies are moving back into this middle ground of rocks. So what I call the not so tight rocks, but also which were not commercial with conventional technologies. So what is a super basin? Well, basically, any classification is just a human way to kind of throw some stuff in the same barrel. And we looked at all the basins with at least 5 billion barrels of that have been produced already, which gives us a proxy for the fact that they're mature, they have infrastructure, they have services, they have a history there to produce, and these basins also have 5 billion additional to produce in the future. We also look at basins that have 2 or more primary source rocks or petroleum systems and stacked reservoirs, so that under one piece of ground, you may be able to go in and produce from 3, 4, or 5 reservoirs in one spot, rather than kind of the traditional model in the past was 1 and 2 if you're lucky. Big transformation in that change. We also found 25 of those basins around the world. We also identified 24 tier 2 basins that only had 1. They were smaller in terms of resource. They only had 1 major source rock, but the Permian became our model. So here's what happened in the Permian Basin. It was discovered in 1921, and big boom. The production peaked here in 1976 and then began to decline. And there you see a little stair-steppy, and that was different oil prices and different things would happen. And, but the big turnaround happened after really about 2010, and it was the advent of the use of horizontal wells and hydraulic fracturing. And wow, look at the number of horizontal wells. The production totally turned around. Now, many of you remember peak oil. And I remember one time I had to grind my teeth because there were some peak oil advocates here in Colorado that talked the governor into having a peak oil conference right here in Denver. I was personally uninvited to come and attend because we had information that was contrary to what they wanted to have as propaganda. And I thought, boy, that isn't right. What we need is a sharing of knowledge and insights, not not what is politically correct. But fortunately, that has changed a lot. I'm sorry, that's my only political message. But anyway, huge change. And how has that come about? Well, we at IHS completed correlating every well in the basin. It's over 400,000 wells. We have identified 45 different zones. The Wolfcamp is in here. That's the shale that has been so prominent. But we analyzed what is the potential of future hydrocarbons using organic geochemistry and volumetrics, very scientific approach to it. And in essence, we were really startled. The basin has produced about 37 billion barrels today. And what we determined from this first cut is that we think the Permian Basin has the capability now of producing 1.5 to 1.7 times more oil in the future than has been produced to date. And it's all because of, let me go back. Instead of looking at just this one zone, we look at the basin as a composite and what's happening in the Permian Basin. This is the Delaware Basin, by the way, and this is the Midland Basin side. They're paying $50,000 an acre for leases in the Delaware Basin because they have 6, 7, 8 stacked pays under each, section. Huge, huge. I mean, it got up to 20,000 an acre here in Colorado, but with fewer opportunities for stacked pays. But nevertheless, Colorado, oops, did I totally goof there? Sorry. I want to move on then. What does it mean in the world? Here's the location of the 25 super basins worldwide. You see West Siberia, huge, some in China, Middle East, huge, but here's North America, scattered in North Africa, a little Australia, some in South America. The point is almost 800 billion barrels are identified in these other super basins. We believe to make up that 45 million barrels a day of new production between now and 2040, you need to bring online or have almost 190 billion barrels of resource to drive that much supply. So the super basins alone have that much supply. And that doesn't mean there's no exploration, but it means we're looking at very mature fields. Here's the US. We were at 9.3 million barrels a day. The overproduction, which we've gone through, we see us dropping to about 8.4. The green segment here is Permian Basin. That super basin approach, we think with different formations down here, are going to drive production growth of almost 2 million barrels a day, has the capability of doing that. Don't know that it will happen, but the capability is there. And sorry, with my poor eyesight here, I was trying to find Niobrara Force. Niobrara is here, I believe. So, sorry, no, Niobrara is up here. It's a little smaller. But, and the Eagle Ford is there and Bakken is here for Bakken in Montana. So other details underneath this hood, why is that happening? Well, here's the amount of oil being discovered, and at the break-even, what we see is the break-even cost plunging in the last 2 years. Here's capital efficiency. What we saw is back in 2013 was we had costs there, or excuse me, you had about 50 barrels of production that could be generated from $1 million worth of investment. So each $1 million would generate 50 barrels a day. It's over 102 barrels a day now for that same million. So that's a huge difference, and that's why, I mean, the whole world is going to benefit from this because there's more oil and gas that will be producible at lower prices than we experienced over the last decades. So if you look at Permian Basin, here's the price of oil going up slowly. Here is cash flow. historically, the whole unconventional revolution was condemned because it didn't generate positive cash flow. Major changes going forward. Going forward, even with lower prices, these plays will be more profitable than they've ever been in the past. Huge change there. Eagle Ford is there. Bakken will not quite as robust as this, but will come into play. So let's look at what to the future then. What does this mean? Did a study of the top 100 plays in the world, and here the bar for conventional, little over 750 billion barrels. The unconventional recoverable, we think 250 billion. The not so tight, that's the going back into the conventional basins and looking at rocks, producing them unconventionally, that is horizontal wells and fracking. And then heavy oil. There's a lot of heavy oil. Obviously, our big picture in the North America is Western Canada, the oil sands. I know they're under a lot of pressure environmentally, but they are really critical to, one, energy security and our supplies in North America over the next decade or two, for sure. You can't just turn off that spigot. There's nothing to replace it with readily, unless you want to get buddy-buddy with Venezuela, because you can import the same stuff. So having it in North America is really important. But around the world, there's a lot of resistance. A lot of European efforts have stopped heavy oil developments in the Congo, for one. There's a lot of resistance in a big project in Madagascar. We can look at that on a map. Here's essentially the Madagascar one and the Congo. But the point is, if you look in the reds, that's the conventional, and you see a lot of it's offshore and in the Arctic. Arctic also is high cost, environmentally sensitive. The point I'm trying to get at here is, if you look at the greens, which are the unconventional, and the yellows the not so tight, and we just selected some not so tight. They're scattered around the world. They're readily available. They're already in areas that produce. And the point is, we think there's a possibility of a huge shift away from the really environmentally sensitive areas in the world to produce more oil and gas from areas where there's already the infrastructure and development. If you look worldwide at break-even costs, you have the Middle East here on the far left, and gradually we ramp up. Here's the sort of magic $60 threshold. A lot of this is offshore. Sorry, I'm trying to see the North American tight oil is here, a big range, but average is still under 60, but we're seeing a lot more of this oil in the below $40 range too, that's being produced or capable of being produced. So the settings, Arctic, we've talked about. I think probably it's going to make more sense going forward economically and environmentally that there'll be less effort to do drilling and production in the Arctic. Deep water, we've talked about a lot. It has a big potential, but it's really getting back to this situation. You know, I goofed on one. I apologize. I wanted to get back to this. Oh, there it is. If you look at the super basins compared to all of these as separate targets, and this is the way we've thought in the past, the super basin target is way up here. And that is in these areas that we know there's infrastructure, there's experience, there's services. And so we think that we're on part of this transformation will be moving in the future away from the high cost, environmentally sensitive frontier exploration more and more into these super basins where there's already a lot of expertise production like the Permian Basin, et cetera. So I just wanted to make sure we had that point well made. If we look at the conventional offshore, we see here's the size of the prize and the break-even cost, and you see a lot of in the $60 and $70 break-even ranges for conventional offshore. So at the moment, unless there's additional cost efficiency there, we can't look for those offshore conventionals to be the major place for future supplies. That's another reason I think the super basins will have a heyday. If you look at gas, very challenging oversupply situation worldwide. Demand is growing, but like the big discoveries in Mozambique, et cetera, we're looking at almost twice as much LNG capacity, future supply being talked about as demand. And so a lot of these projects just aren't or can't happen, but it's going to take a decade or more for this to really sort out. And the thing is, for US producers and those of you in this program, we were hoping the United States would get a big bonus by exporting huge amounts of LNG. Well, we're building the capacity, but the LNG in the United States is the exports are probably going to be curtailed relative to the rest of the world until the market sorts out. So that's something also to be cognizant of. And back to our environmental, here's the growth of 2-degree, the CO2 in the 2-degree model. And where are we here? Well, if you talk about hitting that 2-degree target, we talked about 600, I think it was 66 million barrels a day. If depending on how policies shake out between now and 2040, this wedge for future requirements of oil supplies may look dramatically different. So let me try to wrap it up. And I'm sorry, I was a little slow here today, but I was hoping you might have some questions along. So the oil markets are rebalancing, and November the 30th is a critical day to see what happens between, and it's really between Iran and Saudi Arabia as to whether they will come to agreement of all of them reducing or capping their production. If they don't agree, we're going to have way too much oil in 2017. And so the rebalancing and price increases are going to be shoved forward. We see about $52 a barrel in 2017, assuming there will be some sort of it could be like we are now, high of 50, low of 43. We could see more of that happening. The breakthroughs in the unconventional technologies have really expanded the resource base that's available at less, that can be produced at less than $50. So we're not going to be short and without a hiccup in the Middle East or some place. It could be Libya even, could be Venezuela if they totally have a government collapse down there. That's a couple of million barrels a day that could be off the market. We think that super basin concept really is going to have a lot of additional look at it going forward. We see more and more companies saying, hey, you don't have a big exploration risk. You have fewer above ground risks. You have supply chains, you have technology, you have crews, you have rigs, et cetera, and you have pipelines getting it to market already. So that reduces the need possibly for unconventional frontier, or excuse me, conventional frontier exploration going forward. Deep water will still play an important role, but I pointed out the critical importance for it to be lower cost there. Selectively, and parts of the Gulf of Mexico still look quite good, even at $50 oil. It gets better at 60. And around the world, to accommodate these changes, governments are going to have to change dramatically. We've been going 50 years with, antiquated fiscal terms, just the whole legal systems around licensing, local contents, and things like that have really been inhibiting. You can't do an unconventional development in many parts of the world unless there are changes. So a lot of those countries I showed where their economies are really hurt are going to have to modernize their thinking on how they build a business and a legal climate that is much more in tune with what we have here in North America. So, and that's a big issue. It's a big task. So what may happen is that more and more and more North America will, and countries that will modernize and, their business environment, their legal setting and technologies have a better chance of flourishing going forward. So I'll shut up there. It gives us a few minutes for questions. And but I hope this is a complex story. I apologize. This is like the second time I've tried to run through this. I spent several weeks trying to put this story together because it is complex. I hope I made it clear enough and interesting enough that you at least will make you think about what's going to happen to the future energy business. Anybody have a? Yeah.
The USGS mentioned yesterday Wolfcamp
Yeah.
Basin, 20 billion barrels, 16 trillion cubic feet. You think that more of these discoveries, announcements will happen, but they may not be produced because it's not technological, it's market, the price of oil and gas that will inhibit their not finding exploration.
Yeah. Well, that 20 billion that the USGS just announced is absolutely in line with the part of the Wolfcamp that was in our chart that showed maybe 100 billion ultimately, or 60 more billion in the, we had a little over 20 for the Wolfcamp, and our gas number was high, but we aren't satisfied. We think our gas number is too high, so I'm not going there. But the point is, in the Permian Basin, a large part of that resource that they're talking about is commercial at, $45, $50 oil. There was the recent announcement by, sorry, I'm blowing it here. I'll get to it in a sec. My mind was, it's in slow cache today. The Alpine High discovery, which is partly Barnett, partly Wolfcamp on the far western side of the Delaware Basin. It's in an area that's 40 miles away from other commercial production. Apache in Houston. Sorry, there I get a gold star finally on that. You're seeing a senior mentality in action here. The point is, they're talking about 15 trillion cubic feet of gas and 3 billion of liquids. Now it's yet to be really confirmed and established. It has infrastructure that needs to be built to it, et cetera. But that is another type of discovery within a mature basin province that wasn't expected. Do you know where the two biggest discoveries in the world are this year, 2016 to date? USA. North slope of Alaska, 2 billion barrels. West of Prudhoe, 100 and some miles. That Alpine discovery in the Permian Basin. Nothing else even close elsewhere in the world. So innovation, technology, business climate, there's a lot going here, and the industry, I hope I was getting across to you that the industry is very, very focused on being a good corporate citizen. They've all across the board lowered the environmental footprint, and that goes from whether it's methane emissions or whether it's, you know, use of water. I mean, but the oil industry has technology, it has innovation, it has money. You can't do these things without those fundamental tools. And that's why, I mean, you try to throw out, hey, we want to reduce greenhouse gases around the world. Hey, yeah, let's get behind it. Hey, you got to have technology, innovation, and money to do it. And we can do the best job in the world here. Sorry, any other questions? Yes.
Was the super basin concept, is that something that IHS came up with?
Oh, you know, it's no new law of nature. It's, you know, we've been talking.
First time I heard that.
Well, you know, it's just a term we coined. And I'm sure other people, you know, what you see in terms of new thinking, you see kernels of several people around the world kind of coming up with the same idea at the same time. I mean, we're happy. I mean, we came out with this and published it maybe a month ago. But I mean, it's new stuff. I'm sharing with you our very latest. I mean, I have stuff in here that is less than 24 hours old on what's happening in the industry and what does it mean. So we're looking now at the mini basins, because the mini basins also play a role, different type of role, but the smaller independent companies have, that'll probably be their domain where they can find and develop significant amounts of hydrocarbons going forward. But the idea of the super basin, where you're looking at the conventional reservoirs, you're looking at the unconventional reservoirs, which we couldn't produce at all from until, what is it? It's 9 years. Well, it's okay. So it's 10 years plus in that. And then the not so tight. All of a sudden, well, eureka, gosh, I may have, if you have 37 billion barrels of mostly conventional in the Permian Basin, then you go back in and look at those tighter parts of 10%. You could just add 10% kind of, so another 3.7 billion is possible from that alone. So I like that concept, and I also like the fact that you're not looking at going in and into a new frontier area that doesn't have the legal situation, it doesn't have market in place, it doesn't have pipelines, it doesn't have rigs and supplies and what have you. So that's the main reason for the thinking. It's transformative, but I think it fits. And please give me your feedback if you see places where it doesn't fit, what's really happening in the world, and particularly in the public concerns about climate change and environment. And right now, we think that the super basin idea going forward helps solve a lot of those very knotty issues. And we hope it's a more holistic way of looking at the problem rather than deep water or heavy oil or, you know. So that, thank you for letting me share it with you. And yeah.
For exploration, because we're in mature fields, the leasing is all done, and so on and so forth. For the students and alumni of the GEM program, we're at a stage right now where you're starting your energy, what areas would you look at steer to when you think the opportunities are?
When you're saying areas, you're talking about career style. Okay. Well, actually, they're just changes in focus. The point is, in the Permian Basin, there still is acreage being bought and traded. But the big thing now is, instead of going out and leasing at the county courthouse, it's deals. And it's the deal making and asset acquisition and transfer of assets. And I mean, that's huge. And that all requires a huge amount. I mean, it's land legal dependent for those things to happen. If you're a geologist and you may not be looking for oil in Antarctica and pounding on rocks down there in the summertime of Antarctica, but the unconventional has absolutely revitalized the need for geology, fundamental geology, because for a while it was all seismic. But we're looking at rocks that, gosh, I remember my first wells I sat on in the Permian Basin. Well, I have 10 feet of gray shale. I have another 10 feet of gray shale with a little silt in it. We drilled through it and didn't pay any attention. That's the Wolfcamp, you know? It's 20 billion barrels. Hey, couldn't do anything with it then. So understand the enriched knowledge. It's sort of nanogeology or microgeology, but putting all of those, and it's also the physics. It's the temperatures, the pressures, the transformation of source rocks into hydrocarbons and how they're stored and how can you get them out of the rocks. So that also gets over into engineering. And if you looked at the cost and efficiency management, the big issue here has been management of supply chains and efficient use of your equipment, and you know, you're managing the environmental footprint and all. So to me, global energy management, hey, it's King Kong for the future, because that's where the critical decisions are being made on how to do it right. How to do it right with a very complex set of technologies, and you're also managing a big human and community interest setup. You know, it's a much more complex. So to me, wise management with understanding of the technologies and the appropriate role of energy companies with society. I think your program is more complex, it's more demanding, but I would think smart, capable people should be attracted to it. That's okay.
Thanks for the plug. Before we finish, first of all, I want to thank Pete and give you this
that's really handsome.
token
Thank you.
of our appreciation. And again, thank you so much for coming to
Right.
be with us today. So thanks, everybody.